Hello, everyone. Thank you for joining us today. We've got the asset allocation team here and James Reichert joining for what's hopefully a kind of interactive and kind of fun session to talk about our 2024 market themes. So this is something that a new thing that we're bringing to the firm. So we're going to have a roundtable discussion on these new themes, and you hear more about them at the offsite on Wednesday, the 17th. So with that, I'm going to turn over to Appy, who's going to run the show for us, and we're going to have a good discussion on the big themes for 2024.
Thank you, Phil. I would like to jump right in, and I would like to start with insights, asking all of your insights into what goes into this process. So will you tell me what makes up a theme? What are the criteria that that need to be checked off to qualify as an NEPC market theme?
Yeah, I mean, we can make kind of the quick thought from my mind is it has to be very relevant to market sentiment. It has to be relevant and impactful from kind of a market fundamental standpoint. And it has to be something in our minds that will be impactful in the coming calendar year. This is not something that's 2 or 3 or 4 years out, but a near time, real relevant kind of more than a nudge on the markets in the coming calendar year is what we tried to set in some of our discussions over the last several months. I don't know if the rest of the group has thoughts on that as well.
And I think that's changed from prior iterations of themes, right? Maybe last year's and prior year's themes were maybe more big picture and longer tails, 2, 3, 5 years, maybe even longer. Think, China transitions and globalization backlash is recent themes. I feel like this year's themes are very specific to 2024 and what we see that's going to drive the market. And maybe beyond that, but certainly in 24.
And Appy, maybe directly to your question about how do we come up with these and the process behind it, I feel like a lot of these came up organically in discussions that we were having on a daily basis, whether it was about inflation or the geopolitical backdrop or the Magnificent Seven names, like all of those things then flow into the ultimate list of themes that we have.
Yeah, I think it's fair to say, and I think probably some of us are exhausted by the conversations the last couple of months, but it's in some cases daily, in some cases it's multiple times a day, kind of going through what are the big things that we think are to impact markets, and also is this something that's translatable to how we can communicate with clients? So is it both impactful for the portfolio, but also something that we can engage with our clients on and have a discussion with them on it? It's educational, but also maybe has some relevant actions for folks.
Great. Thank you for that. Now, moving on to the actual themes themselves, I would love to know for each of these themes, and we can take it one by one, why they matter, how will each theme play out this year, and what should investors be doing? How about we start with the cost of capital?
So that the cost of capital theme is my personal favorite, largely because this is the one that I spend most of the time working on. And I think the intent of it is we didn't want to have a theme that just related to interest rates being up or interest rates higher relative they were 2 or 3 years ago. But we wanted to get into how companies finance themselves, how entities finance themselves, how leverage flows through the system, public and private markets, and being mindful of what your cost of capital is going to be, whether you're a single A rated company or a double B rated company, and how higher interest rates plus your credit spread plus your cost of capital, your equity risk premium flow through in the types of things that you're going to be interested in doing in kind of this coming year. So to the extent that you're going to be funding or not funding new additional capex, to the extent that you have troubles getting new capital from the banking sector. And then on the other side of that also is we don't think of it this way, but consumers and individuals have their own internal cost of capital they have to think about. And on one side of it, for many consumers, they have fixed rate mortgages, which are, let's call it sub 3%, financing level. And just as inflation's up, nominal cash flows are higher. That's a big tailwind for consumers. And then for savers that say have parked a fair portion of their assets in money market funds, earning 5% plus is a huge kind of income dividend for consumers that can frankly finance all sorts of different activities, whether it's a vacation or additional savings or just a cash flow benefit that flows through. So it's a nominal benefit to, and nominal in the inflationary sense. It's a nominal benefit in terms of nominal cash flows for consumer spending, which we think helps kind of manage the economic cycle. We had a fair amount of debates of kind of this theme and kind of what's the right fit for it, and whether we should just be direct and talk about interest rates. What are some of the tangible impacts from this? And these are some of the key points I just mentioned are what we came out of.
Yeah, and Phil, maybe to add to that, I think we had some conversations around, could this have been a theme last year, and maybe why is it relevant for 2024? But I think part of it's all the aspects you mentioned about the consumer and about how it's flowing through just to the economy and markets overall. But a piece of this is just that still the market is not recognizing the shift that's taken place in terms of rates being higher and maybe inflation being a little stickier. So I think that almost adopting to this new environment is kind of the important piece to me.
Yeah, and I think within this you'll hear maybe kind of one of Jen's trigger words, which is kind of whether we're in a new investment regime or not. And Jen, you said this is, we're not in a new regime. That happened last year. This is about, or 2 years ago, this is about adapting to the new regime. And part of that is adapting to a higher cost of capital.
Got it. And so we think that the markets will be adapting to this new regime this year, and that's what's going to play out in 2024. Is there anything that we're telling our clients to do?
So I think from an action standpoint, a lot of this already reconciles with some of our positioning, and James, feel free to jump in on this. But thinking about companies that can generate their own free cash flow, companies that have a more kind of slightly bigger balance sheets, kind of more value-centric mindset on the public equity side, and frankly also on the private equity side as well. But also then on the fixed income side, areas of the market that are a little bit of a higher carry, offer a high yield or better offering, we think is a good place in this type of market environment.
And just adding on to that a little bit, I think the quality theme that you just articulated on the equity side also plays through on the credit side. So while we are enticed by yields that are still above 7%, 8% in loan space, what we see is a tilt towards higher quality within high yield and within bank loan, as managers try to find the companies that have managed their own increasing cost of capital better and have higher free cash flow. So I think that idea of quality and cash flow generation is one that will continue to play out throughout 2024 in both equities as well as credit.
Thank you for that insight. Moving on to the next one, the Magnificent Seven. Why does this theme matter? Same drill. How will it play out this year? And what should our clients be doing about it?
Thanks, Appy. I'll take that one. So why the Mag 7, who they are, I guess you could say who they are if you don't know. It's the large cap stocks that outperformed in 23. So think Apple, Amazon, Microsoft, Google, Meta, Facebook. And then the newcomers to that group are NVIDIA and Tesla. So they outperformed hugely in 23 relative to the rest of the index. and their sheer size of in the index, the S&P being a market cap weighted index, added to that outperformance if you owned a market cap weighting of them. So, in 23, they outperformed. So why does that matter for 24? Well, you have to hold the S&P 500 index as an investor, just as an equity investor. And now they, account for almost 30% of that index. So you're essentially required to own these names at a large weight in your equity portfolio and your total portfolio. Just a 60-40 global portfolio alone has a 10% position just in those 7 names. So it's striking, concentration risk there in these names. So why it matters for 24 is because you have to hold these names. They're a large part of your portfolio. So your portfolio is going to depend a lot just on the performance of those names. If they, outperform in 24.
And are we asking our clients to, are we advising them to take any action with regards to these magnificent 7?
Well, I don't think we're making a prediction on, whether they're going to, continue the performance they've been on, stay stagnant, or, go down. I think it's just saying, okay, you have to own these names. They're going to influence your portfolio. And I think we're relying on historical references, times like the pre-dot-com era, where you had a similar concentration of, large cap growth stacks, or the Nifty 50 era of the 1970s, where people were saying a lot of the same things they're saying about these names back then. These names are big names, they can't fail, strong balance sheets, yada, yada, yada. And then in those 2 periods, these top performers, just kind of waned in the future years going forward. And the average stock kind of caught up to those high growth names. So I think our implementation is to stick to a value tilt in your equity portfolio.
Yeah, because it's such a nuanced view. We probably could take hours and hours to kind of talk through this, but we've had discussions on the regulatory risk associated with the Mag 7 and kind of antitrust concerns to the China revenue risk if there was some sort of kind of concern that arose there. And then also at the same time, kind of Rob, you alluded to this, like what slows them down in the next 12 to 24 months. And it comes down to kind of tracking our risk and our risk tolerance when we think about some of the positioning, especially in that large cap space for the US.
Yeah, and tying back to the last theme, many of these companies have negative net debt, and what that means is they loaded up, issued a lot of debt previous to the current higher rates at very low yields. They actually have more cash on their books than they have debt. And since they issued this debt at lower yields, they've got a net positive spread by holding cash. So, that's unique for these companies with that negative net debt posture relative to a lot of other large caps. So I think, they do have that tailwind as well.
Okay. Thank you for that. Our next theme is US fiscal debt. Why does it matter, and how will it play out for this year?
This is mine as well. So fiscal debts, I think what we want to say about fiscal debts, we show the path just based on, congressional budget expectations of the debt, and it's growing to unsustainable levels. I think what we're saying with this theme is that we're not saying if that matters, we're saying in terms of debts and fiscal budgets, whatever, we're saying, how is that going to influence investors in terms of, okay, how is that going to drive interest rates in 24? We kind of saw a roller coaster in 23. If you exclude, the banking crisis in March, we saw rates just climb as the Treasury had to issue more bonds to finance these deficits. So with close to 2 trillion in net debt that needs to be financed in 24, that's a lot of supply of treasuries going to market that needs to be consumed at the desired interest rate that the Treasury expects to pay. And if that's not the case, expect treasury rates to go up. So, and that's obviously going to influence fixed income investments for investors.
Yeah, and here again, that cost of capital, right? It's coming home to the sovereign in this example where, there is a higher cost of capital, and the U.S. Treasury is going to have to deal with that even with a higher fiscal spend every year. And you do have to wonder, where they will issue that debt and where will the buyers be? If cash rates do still stay high at 5.5%, do you still get as many buyers further out the curve at yields of only 4%? That could also be an impetus for the Fed to lower rates this year to help the Treasury manage their own financial situation. So I think, there's a lot of things that could come from this theme in 2024 that go beyond just kind of the ramifications of a growing fiscal deficit.
Is there anything we're telling our clients that they should be doing?
Yeah, I think it's always important to have appropriate liquidity and safety in your portfolio. And so while this theme is about, the U.S. Treasury investments, we are not afraid of holding U.S. Treasury investments, and they're the safest investment to have, should we see a recession or some other geopolitical risk. So this is not a call to say, don't hold your safe haven investments, don't hold safe treasuries. It is a call to say that, there is a certain level of interest rates that might be more attractive down the road. And when you own things that might not yield as much as cash, that aren't necessarily safe haven assets, I'm thinking investment grade corporates that currently have yields less than cash across the curve. To the extent you don't need that duration, cash might be better. So I think, the theme here is one of hold your safety, but recognize we could be in an environment of continued higher rates at the back end of the curve, and position accordingly.
And I think this is also one where, it's a presidential election year. That's a little bit of a commercial for Jen as well, who recorded a election overview session that is available for everybody to watch, along with a slide deck that's attached to it. But it's clear the fiscal deficits and kind of treasury issuance is going to be something heavily discussed, and you can have a fair agreement that both parties seem to be bigger spenders, each in their own ways. And while the market fundamentals may not be directly kind of impacted kind of in the current year, but the sentiment and the volatility within rates is definitely something that we could be seeing, and which just reinforces the need for liquidity and having kind of a balanced targeted position in safe haven fixed income.
Great. Thank you for that, Phil, and everyone else. Moving on to the next one, which is artificial intelligence. AI, why does it matter this year more than others, and how will it play out in 2024?
Yeah, I can take this one. Part of the theme is to kind of define what AI is. And, hearing it a lot in 2023, there's a lot of, differences in opinion of what artificial intelligence actually is. The other component is, the thesis is pretty simple to understand. Like other technological revolutions in history, artificial intelligence has the potential, to really permanently enhance labor productivity, boost real economic growth. The successful adoption of AI will have implications for corporate fundamentals that could support longer-term equity returns as well. And with, similar to other like new technologies in history, looking at, smartphones, looking at internets, personal computers, et cetera, they're adopting these new technologies have typically been slow. And while there's reason to believe that adoption of AI could be faster, it's unlikely that AI will cause, corporate fundamentals to be significantly different over 2024. But what we will be able to see is whether there's, continued and growing interest in AI, looking at companies like NVIDIA, AMD, are they still giving out strong guidances, which will not only test their own valuations, but it will also help gauge whether companies are willing to continue to invest in AI, and whether there are more companies investing in AI. Another impact that we can see in 2024 is just that downstream impacts of AI haven't really been priced in yet, especially companies outside of the technology sector. And so in 2024, it's important to see if companies are able to incorporate AI into their own industries and bring tangible new products or even new initiatives to market that could really provide a further tailwind to equity returns in the short term.
I think what's interesting is we at times have talked more about this than any other topic throughout the year. Some of it somewhat random in our conversations, but also entertaining. Is we haven't tried to say what the success of AI will be. We've kind of said that's a binary. Is AI a real thing or is AI a bubble? We don't know the answer to that. No one knows the answer to that. And I think what we've kind of outlined here and what Jack's done a really great job at is we're going to make an assumption that AI is progressing, and here's the path by which it progresses. And if it does progress from some of the tech names to other parts of the economy, you get that productivity boom. And I think it's fair to say there's going to be a big proof statement in 2024 around a lot of the things that Jack mentioned. And I think that's been the kind of the crux of the conversation of, is this something that we should be focused on in 2024? And I think the answer we came to is yes.
And I think it's so hard to quantify the impact of AI because as humans we think linearly, things change at a constant rate where technology moves exponentially. So it's really hard to grasp how fast things could change. Just look back 10, 20 years just in how tech has advanced. I mean, AI is just going to make that all go a lot faster. So it's really hard to even capture or quantify the impact.
Yeah, spot on.
That makes sense. Is there a way investors can position themselves to take advantage of any of this, or if any of these trends that we're talking about in terms of AI?
So I think markets generally overestimate short-term technology benefits and underappreciate long-term benefits, kind of what Rob was alluding to. But as long-term investors, I think it's important just to not be deterred by short-term volatility that may or may not happen, and look at the longer economic fundamentals. And if you do believe in this AI as the next technological advancement, being invested in equities, U.S. equities, is probably the best way to get exposure. The U.S. is probably best positioned to benefit from AI due to relatively friendly regulatory environment and just being able to access the key inputs.
Yeah, I think that's a great point Jack makes. Is the long-term benefit is maybe underpriced and the short term is overpriced because if you listen to some of these firms like OpenAI and other developers of AI, they're more focused on the general AGI and artificial general intelligence, which is AI that it just can go live its life by itself and do things on its own. Where we have narrow AI where it can only kind of do one task, like think ChatGPT, where you just type it questions and it has a kind of limited scope. Really, that long-term generalized AI is the big long-term tail to this, and that's really, I think, going to be the game changer.
Great. Moving on to our last theme, which is geopolitics.
Yeah, I can take this one. Especially in 2023, I think we saw some pretty meaningful changes to the geopolitical backdrop. Rob mentioned earlier that we used to have a theme around China transitions and US-China relations, which I think that's still a big piece of this, but some other things have changed. We now have the highest number of military conflicts since the Cold War. There's 2 ongoing wars in Ukraine and Israel, but there have been even some other different issues that have come up more recently around the Red Sea or the Strait of Malacca, for example. So there's a lot of different ways that we're seeing geopolitics play a role today. And I think the result of a lot of these changes is just that we're seeing more fragmentation around the world. So you have this increasingly polarized world, which at the center does have that US-China strategic competition, but there's also all these other countries that are yielding a little bit more influence from an economic standpoint than maybe they have in the past. And India is kind of a good example of that. So all those countries that are in some ways kind of caught in the middle, they're going to help determine what the balance of power ends up being at the end of the day. So kind of interesting with that backdrop, but I think generally in coming out with a geopolitical theme, there's this thought that we'll be speculating on different tensions or flashpoints, which is not really the focus here. We want to just frame it that we have transitioned maybe away from this environment of relative geopolitical stability to now one that has the potential to surprise markets and to introduce uncertainty. So there may be some tail risks that come up if tensions escalate around the world. And maybe kind of getting to the specific point on why this is relevant for 2024, there's a few things. Phil mentioned the election component, not just US elections, but there's a global election cycle where over half the population is going to the polls. So, it's hard to speculate on individual election outcomes, but that can change the trajectory for some of these countries in terms of policy. So that's one thing just to kind of keep in mind as we go through 2024. And maybe from more of an economic standpoint, all of these tensions that we're seeing introduce some potential risks around growth and inflation. So those are the two things that I think are likely most exposed from an economic standpoint. Should we see economic activity be disrupted, that has cascading effects to markets as well. So those are some things that we're just going to be looking at as we go into 2024.
Great. This is such a comprehensive list of themes that, market themes that we should be looking out for in 2024. But I'm curious to know, what are some of the themes that were in the running that didn't make it to this list? And, why didn't they make the cut?
I can kick this one off, and I think everyone's smirking because I was making a case that there should have been an inflation theme. But as I think you've heard throughout every single one of these themes, there could be an inflation element to each of them, depending on how they evolve throughout the course of 2024. But the real kind of key that I think we're thinking about with inflation is you have this environment where the market is pricing in this return back to the previous market regime with low interest rates and low inflation. And what we're seeing today, we don't really think that that is a likely base case moving forward, in part because there are some cyclical and structural factors that could be a little bit stickier and create some upside risk for inflation. So that's one that I think you'll see maybe elements of that as some of these other themes evolve.
Yeah, and I think another one that, James, this is one that you and I kind of had many discussions about, was this idea of kind of a resurgence in labor or a change in the labor market. Everything from, the frequency of strikes and union activities higher to what does this mean to higher wages and higher salaries. It's not necessarily we're going to go back to the kind of peak levels of collective bargained workforce that we saw in like the 1970s, but the idea that the influence of labor, the influence of wages is maybe on a little bit of an upturn, and it's something that we talked a fair amount about, and it's hard to see quite yet that there's something clearly we can say is relevant for 2024, but it sure seems like something's different post-pandemic in terms of labor force. And I think everyone in the markets, everyone, in kind of the economy is still trying to identify what is that exactly.
Yeah, I almost think of that as a mega theme that's like in progress, that's live and happening right in front of us. That is part of what gives us comfort around this idea of, staying invested fully in equities at a time when you might look around and say that they're certainly fairly valued, if not, highly based on, any longer term historical modeling. When you look around and you see a really healthy environment for jobs, and not only a healthy environment for jobs, but one where labor is able to command an even higher share of the earnings that are out there, that really should support a broader U.S. economic base that eventually will pay dividends. And I think again, it feels a little bit like a mega trend in progress.
Yeah, I think we kind of there's kind of many other kind of discussion points from the Fed balance sheet, which we're actually not talking that much about this year, and it's kind of steady runoff that was something we were thinking about, to kind of thinking about the dollar, and kind of its impact, discussions around kind of trade and onshoring, kind of bringing more trade to the U.S. or more production to the U.S. And it gets back to kind of what's, is this a kind of second derivative effect or something that kind of directly can impact the markets? And those are some of the debates that we had. But I think in the end, we came down to kind of five themes that I think are really, really relevant right now. But we'll see at the end of the year, are all five still relevant? History says it's probably not going to be the case. But it's certainly something that we think is relevant today, and I think everyone did a great job in terms of putting together some slides and some graphics and that try to highlight and kind of explain the themes to the best that we could. Jack's got some quality examples and thoughts on AI and the presentation, and definitely looking forward to sharing all this at the offsite on the 17th.
Awesome. Thank you, everyone. I hope the rest of the firm and anyone watching this enjoys this discussion as much as I did. Thank you.
Thank you all. Thank you. And just as maybe kind of a quick commercial, if you're watching this, then you've been to the Confluence offsite site, and in there you'll find additional recordings on our current opportunities, our strategic views, a kind of process outline around dynamic tilts, a kind of two recordings on the year in review. So a session from Jen talking about the macro backdrop, and then a selection of some of the favorite slides from the team in terms of things that happened this last year. And then you also find this themes discussion focusing our five themes of cost of capital, Magnificent Seven, U.S. fiscal debt profile, AI, and geopolitics. So I named all five, so check the mark there. And thank you, everybody, for joining us. And thank you to the team for all the work of the last several months.